The government did not shut down. I know, bad news. But today we're going to look at something that's not only 10 times bigger, it's like 100 times bigger because these government shutdowns are ultimately distractions from what's much more important. So, the first thing I want to talk about is we have countless indicators firing off in the bond market, and these are big ones. So, we're going to talk about that and what it means. And then I also want to look at investors needing to watch a few changes in these trends that have occurred. I'm going to tell you what you as an individual, as an investor, but as just an individual person need to be looking at right now so you can adapt, so that you can thrive and prosper. Let's begin. Here we have it. Threat of government shutdown ends as Congress passes a temporary funding plan. Oh, yeah, that's right. We've heard this all before, the song and dance. They're going to extend it yet again, in this case, 45 days. They'll kick the can down the road, and on the 45th day or 44th day, they'll come to some sort of conclusion, and ultimately you will have to spend more money than you did before. Wonderful. Okay, so we'll look at the bond market, but we're also going to look at a few other things. And here we have it. Equities are competing with 5% returns on cash, which is basically no risk. They used to say TINA, right? There is no alternative. There are alternatives now for equities, and that's why we see a lot of money that's been going into bonds as opposed to before. It would always be equities all the way. Something very big has changed inside of the bond market. And of course, I need to show you that. Here we have the bond market has never sounded recession alarms for this long. 10-year yield has been below the 3-month rate for 212 trading days. Unbelievable. The quote, ignore the signal at your own risk. That's something that you can't really ignore. All right. Key treasury curve inverts for a record period of time. And certainly we have fluctuations and variations. But when we see these records, we should definitely pay attention because now we're getting into some very dangerous territory. Ultimately, yield curve inversion is something that has extremely accurate indicator of a recession that's coming. And we are now in that period. It depends on which one you look at and so on. Don't get involved in all the intricacies. All you need to know is that the bond market is signaling a recession, and we should be paying attention as a result of that. Easy monetary policies for so many years screwed up this system. Since the early 80s, we've had consistently falling interest rates. And during that period of time, falling interest rates, we see more borrowing, more debt, more expansion, more government stimulus, and more actions from the Federal Reserve, including more recently quantitative easing. And now something very different has happened because for the first time, we've had more inflation than we've ever been used to in all these decades. So now it's breaking the system. And that's why I want to show you this. This could be the most significant chart of our time. 30-year yields decidedly breached a down channel. There are a few things in this chart I need to note. First of all, this is showing us from the mid 80s up until the present, it was a downward channel. And it would fluctuate, but ultimately less and less and less yield as time went on. Imagine taking on 30-year, you're going to invest in something that's going to pay you back 30 years from now. And you're going to get, in this case here, like 1.5% at the bottom. When you looked around the world, where would you get your yield from? Oh, I'm going to go to Germany. Oh, it's at a negative. Oh, I'm going to go to Japan. It's at a negative. Well, now, 1.5%, better than nothing. So you had these companies like SVB that were going out and buying mortgage-backed securities so that they can get some yield, so that they can get something to get more than 1.5%, so that they can attract their customers with a higher return. Oh, give us your money. We know a way and we can get you, let's say 3%, 4%, 5%, whatever the case may be. And that's the way you attract customers in. Give them a higher percentage. But that means you have to take more risk. And at that time, it was super risky. A lot of companies were doing the same thing. We just haven't found out about it yet. We will. All right. I would like to make it clear that there were many of your fellow YouTubers out there that were suggesting this would not happen. You see how it broke the channel? Many, many, many of them were suggesting this would not occur. And yet it has. So if they haven't apologized, if they haven't admitted that this was like clearly the thesis, their entire thesis was incorrect, if they haven't acknowledged that, something is very wrong. And I would say you got to start to challenge the other assumptions that they've made. What I have said for a very long time is quite simple. At some point, you can read it in my book. At some point, there's going to be a lot of inflation. They're going to have to bring that down with higher interest rates. In doing so, it's going to cause a problem. You're going to have an issue, a financial crisis of some sort. That's obvious. But the argument was, we're never going to have that inflation, so you don't have to worry. They're never going to increase interest rates. I mean, it's preposterous to even suggest that. Here we are. Here we are. It was pretty obvious what they were doing. And 11 interest rate rises later, we're still wondering at what point does this all end? But anyway, this is the point. This is the chart. Pay close attention. You can see what has happened just looking at it up until this point, comparing all the different sectors. Which sector has performed very well over the last few months? You see that black line? That's energy. Energy has done very well. So while everybody's so focused on an NVIDIA stock, we'll continue to bring up this important statistic, and that is money market fund assets. That's the green line, because people are going to get 5% plus in a money market fund. And yet the banks, the deposits have been stagnant since earlier this year, since late March. We have not seen that move. And why? Well, that number one, that's hurting the banks because they're saying, uh-oh, we got to attract more. How are we going to do that? We can't, because we're not going to be able to offer 5-6% to get that in. We're going to struggle. And so they can't loan out more. They can't do what they want to do. And so this is a big concern. And I think underlying all of this, the banks are still in trouble. What we see overall is that the reserves and the stock market, they're they go along with each other. But that really, a few months ago was a big difference in between the two. And I was saying over and over again to my mentorship group, I was saying, watch this. These will converge. And look at where we're at. We have certain indicators that are, I don't want to say bulletproof or foolproof, but my goodness, are they accurate? So keep your eye on the very select few that have really good track records. But what's going on with the retail investor? Well, at this time, you could see what they're focusing on. And I thought that was odd that the number one thing was dividend investing. By the way, AI is number two. The average person, what they're most interested in is attracting yield. And right now, dividends in the market, not very attractive. If I'm going for dividends, I would if that's what I want that quarterly income, for instance. Why wouldn't I go to a bond right now? If I'm just going to, that's what I'm going after. Because the yields are significantly higher, usually, in the bond market. And that's what, there's a disparity going on right now. Just keep that in mind. Apple's list of challenges in China appears to be growing. The country is tightening restrictions on the App Store that would eliminate a popular loophole. China accounted for billions in revenue for Apple last year. And so this is important if you're an investor in Apple. The Chinese market is key. 95% of the production of the majority of Apple products are done inside of China. Know the exposure of that company to other markets, whether it's China or what have you, because that disruption could actually have a material impact on the stock itself. And then the very last thing, we need to look at what you can do. Few things. Follow the smart money. Bonds are saying to take your foot off of the gas right now. You got to watch out. You've got to be very careful. And that doesn't mean put your foot on the brake and throw all your money in your bunker and hide down there. It just simply means, whoa, watch out. Let's be careful. Let's use a more cautious approach. Being mindful of a company or business exposure to risk. And so we see that with China specifically, as we just talked about a moment ago. This goes for anything. Watch where they're getting their raw materials, where they're getting their finished products from. If your individual business is heavily exposed, you've got to watch that as well. Okay. Don't get stuck in a belief system. Challenge yourself. I know a lot of people that get on a bandwagon, they just get into this whole thing, cheerleading and all that. No, no, no. Challenge everything, question everything. Okay. Very important stuff. I hope you appreciate that. And if you want to the whole deal and you want to understand everything about the financial system and really understanding financial education, head over to my website. It's totally free. So this is what you'll see when you go to themoneygps.com. And that button on the left side there, it says Compass. So when you click on Compass, you're going to get these, 20 videos or 10 videos, whatever it is. You're going to go through, you're going to click on those, and you're going to be educated in such a simple and easy to learn manner. And then you could share that with your friends and family. Okay? There's no paywall, there's no email, there's no ads, nothing. Just go in there, learn, and I'm sure you will appreciate this. Okay? Comment of the day. All right, thank you very much, Feather, for this. I got a grim revelation that the majority of people are already completely broke as of now. I went to get money out from one of my accounts. It had $2,500. And the teller remarked, "Wow, you're quite the saver." I personally don't think that 2,500 is a large sum of money, but evidently most people have much less than that in their accounts. This is the state of people where they just don't have savings. They don't have enough left at the end of the day. So that's why we need to take action. We need to do what we can as best we can. All right. I appreciate you being here today. I appreciate you dealing with my voice. We got a few more days of this, hopefully. And I want to thank you for being here. I'll see you on the next one. Take care.